So, um, let's talk about the massive sell-off that just happened. This silver crash wasn't really a sell-off; it was really a dealer reset. What do I mean? I mean the the recent plunge was not a breakdown of fundamentals, but it was a paper deleveraging event that masked ongoing physical tightness, right? So let's take a look at this one here. Future prices can go down sharply without fixing the real world shortage because futures are leveraged contracts, not the real metal, right? So, what does that mean? Gold and silver futures are traded on several exchanges around the globe. We know this. Um, they're basically a legal agreement between buyers and sellers for the purchase of an asset at a specific date in the future. So you can trade something now for something that you might have later, right? So when you're saying I'm short future, or you can say I'm buying to close, right? To go neutral on a future. So you're buying a future. So when the banks go shorting a future, um, they are expecting the price to go down, and when they're buying to close, that can bring the price back up, right? Um, it says here, who uses future contracts? The use of future contracts generally fall into two broad categories: hedging and speculative purposes. Now, most retail investors, most prop firms, we're going to be on the speculation side, but the banks, they're going to be on the hedging side. So what they'll do is they'll write something, a contract called an over-the-counter contract, right? They'll take that to like the London OTC uh, dealers, right? And they'll say, um, I'm agreeing to provide 1 million ounces of silver in the future for a certain price. I need to hedge that. So I want you to take the obligation of this contract. So London will say, fine, we'll take that obligation. But at the same time, to hedge that so they don't lose money, they'll go short the exact same amount of ounces of silver on the futures market. So they have to go short. So they have to short the futures market with a particular date and amount to hedge or cancel out the OTC contracts that they write, right? So it says here, hedgers may include producers, portfolio managers, consumers. For example, a farmer produces corn. He's concerned about the bushel price that might fall, which could reduce his profit. So he could sell a futures contract. If the corn farmer sold the future contract today for delivery in 5 months at a price of $4, then if the price of corn falls between now and then, the farmer would lose money on his cash crop, but would be offsetting those losses by gains made on the sale of the futures contract. So when you're shorting a contract, if the price goes down, you make money. But if you write obligations for to deliver something in the future for a certain price and the price goes down, you lose money. So you write the futures contract against the obligations to hedge or cancel out. So you don't so you're reducing your exposure, right? So what people need to understand first is that silver doesn't trade in one market; it trades in two, right? So there's the paper market, that's the futures, derivatives, highly leveraged, settles mostly in cash. Um, and then there's the physical market, which are bars, coins, real inventory that has to be mined, refined, shipped, delivered. When paper contracts um, crash the paper price and the physical premium stays elevated, that's not always a contradiction. but it is a disconnect. The relieved pressure is what is intended by the crash, and it doesn't add any physical ounces to the real world, but it reduces obligations for those banks that are crashing that. So this article talks about that. Um, First, we need to understand COMEX, which is operated by the CME Group, serves as the main exchange for silver, derivatives, options, and future contracts. While the physical silver can technically be delivered through COMEX, the reality is that most trades settle in cash. Traders are not actually taking delivery of the metal bars. They are making bets on the price movements, rolling contracts for it, closing positions for cash profits or losses. Right? This creates a situation where the paper trades one way while physical trades very differently. So when you actually go to buy the silver, you're paying a premium over that spot price, and those premiums grow when paper shorts increase. According to the London Bare Metals Exchange market analysis, the exchange for physical, the spread, which measures the difference between COMEX futures and London spot prices, has expanded to historical averages. Or I should say, expanded past historical averages. So historically, they might have been 25 cents, maybe a dollar. Recently, we can see tracking the spread here. It's been going up this year, recently. Another thing they'll do is they'll mark they'll hike the margin, right? So when the margin requirements get raised by 20 or 30%, it means that the requirements to trade those futures increase. If you cannot afford, you get liquidated and forced out of the market, which leaves it only for the big banks to play in those markets. Simultaneously, while you're hiking those margins, if they're dumping paper into the metal and lowering the price, they're benefiting from that, right? So that's called a forced liquidation, right? Basically, a forced liquidation is when they raise the margin requirements, like I mentioned, and force people to sell because they can't meet those margin requirements, which lowers the price. It's called liquidation, pushes the price downward. It doesn't mean any of the fundamentals are bearish. It means that it was a mechanical lever that they pulled. So this is talking about backwardation, right? Um, so we'll go over that. Silver backwardation occurs when the silver prices exceed the future delivery prices. This creates an inverted market structure, right? The spot price of the commodity trades higher than its future price. In normal market conditions, future prices stay above the spot price. This price inversion shows that buyers want immediate delivery of the physical metal, and they pay extra to get the silver now instead of waiting for the future delivery. So when the spot price is higher than the futures, high demand for immediate delivery, limited physical supply, market stress indicators, normal market contango, future prices equal the spot price plus carrying costs. whereas backwardations, the future price is less than the spot price. Okay. So you might be asking, um, why does this matter, right? So when you have the paper versus the physical market, and you also have forced liquidations and backwardation, timing matters, right? Um, the futures expiration dates, the date when the future is going to expire, traders either have to roll, deliver, or exit those trades. Most paper longs can't deliver the metal, so when the liquidity dries up, especially with repo cash being pulled or redirected, positions get closed aggressively. Dealers know this. They let the price fall just far enough to force exits, reduce open interest, and then they reset their positions. The result looks like a crash, but structurally it's just a cleanup, a dealer mechanism. So why paper dip buyers get kneecapped, right? So effectively, um, this is where the retailer gets hurt, right? Buying the dip in the paper assumes you can survive the volatility long enough to be right. But you know what they say, the markets can remain rational, or I should say, the markets can remain irrational longer than you can remain solvent, right? So the leveraged instruments don't reward patience, they punish it in those cases. Even if silver ultimately moves higher in the direction you think it might, margin calls and volatility can force you out of your contract before that plays out. That's why dip buying futures during liquidity stress traps is a bad move. You're competing against bigger banks, bigger balance sheets, and they can wait longer than you. And they also can move the price to where they want it to go, and you can't. So it's an asymmetric warfare, right? They can always hike margins in the middle of those contracts. If you don't have enough, you get liquidated, right? So the question is, why does that happen, and what is the right strategy? So instead of dip buying to trade, what you would need to do is take the sovereign strategy, right? So this is the long game where you're not trading, but you're just accumulating over time, stacking, whether that's disciplined individuals, sovereign wealth funds, large institutions. You know, you're not buying on contracts, you're not buying on trading the volatility, you're just stacking physical metal. Not paper, physical. Paper traders are fighting margins, mechanics. Physical holders are insulated from all of that. Dealers can reset weak hands, reduce leverage, play hardball, but they can't go into your vault and physically take out your metal, right? So the sovereign long game always wins, basically. Some people are saying this is book profit taking. I wouldn't call it that. Some people are saying it's a stronger dollar. I wouldn't say that either. Some people are saying overbought. I would not say that. Now we're getting into margin requirements and forced liquidation. That now we're getting into the correct reason here. Asian markets are helping, but they don't necessarily want to play that Western game. In fact, they pause usually and they protect their markets, whereas the CME works with the banks to protect their own books. Right. So even here is saying why physical buyers are not affected. The critical difference is to separate paper from physical silver. Right. all these margin rules and paper crashes can affect paper silver. It will not affect physical silver. If you own physical silver, there are no margin calls, no leverage requirements, no forced liquidations. It's just you and your ounces. Right? A lot of people are saying certain banks like JP Morgan were at the root of these crashes. CME Group, a lot of people were pointing fingers at CME Group. So, that's basically the thesis here. So effectively, this was not a silver crash; it was a dealer reset. As I explained, they are physically. Now, if you take a look at the chart, right? Let's take a look at the chart of silver. You'll notice something very peculiar here. If you let's look at the 1 month. You'll notice that, oh wait, this is, let's go with COMEX silver. Yeah. If you notice, we are right back at where we were at the beginning of the month. So January opens, right? And we're at the 70-ish level. There's a massive run up. Banks don't like that. They smash it down. Asia buys it. Retail buys it. Unprecedented run. Gets up here. They smash it back down. Doesn't work. Rises again. They smash it back down. Doesn't work. Rises. At this point, they say, you know what? When January opened, we had a thesis probably somewhere around where it started in January, right? So January opens, they start shorting around 70. It doesn't follow their model. So normally, if you make a bad trade, you just lose your money. But when the banks make a bad trade, well, they don't want to lose money. So they just, force the market to do what they want. They said they said their short positions were gonna win, and they were losing. So they said, you know what? Let's just crash the market so that we win. So what happened was they brought it all the way back down to where it started that month, got rid of all of those gains, liquidated a lot of positions, a lot of people lost money, and now we're back to this level. It's been trying to it's been trying to go back up, but every time it does, it hits the sell wall, and it stays right where they want it. So my thesis is do not dip buy right now. If you were trying to dip buy in this red wave here, you would have gotten losses. And my thesis is it's going to grind sideways for a bit. It is not going to rebound sharply immediately because the banks smashed it here, they smashed it here, they smashed it here, got really fed up and just went nuclear here. So if the banks are this aggressively defending, it's not going to go back up. They're not going to let it because they control the CME, they control the futures market, they control these databases and these numbers, right? They can print as many contracts as they want. Unlike the average guy who has to actually put up real money, banks can create money out of thin air and print as many paper contracts as they want without any physical backing, right? So they're not playing by the same set of rules as the average guy. If it did go up, it only went up because they were letting it go up so they could smash it back down. I don't think they're going to let it go up again. That's why they hiked margins more. You know, they probably say let it ride up a little bit, so that so that everybody everybody who's long will go ahead and get in, and then we'll break them psychologically. So this was not an accident. It didn't. When it rose up, they wanted to see how much it would rise. Right? They were letting it rise. They did smash it back down, of course, but they were testing. They were seeing, we smash it this much. What is the resistance? How much pushback are we going to get? So they were smashing it, and then, they had 1, 2, 3, 4, 5 different smash. They got the data they needed, and they said, "Okay, hit it now with the nuke." At this point, it did try to rebound. They smashed it back. So they're going to pin it to the price they want, and my interpretation is they're going to keep it here for a while. Could it go back up? Yes. Will it go back up? Probably not anytime in the near future. Now, it could rebound. If it does, more than likely they're going to smash it back down again to the level they want. I mean, they've been doing this for a long time. They've been suppressing these metals for a long time. I'm still bullish, but structurally bullish, right? It's only going to get to the point where they cannot smash it down anymore, right? If you zoom out on the all-time, we can see that let's go with okay. So as we can see, historically it's been pretty low, and it's been suppressed. In 2011 it kind of rose up. They suppressed it again, and it didn't rise up again until maybe around 2020ish, 2019. But they didn't really let it spike. They smashed it back down, and now we've kind of rode back up again. I'm expecting this trend to continue. They'll smash it back down, and it will keep riding. So there will be opportunities, but I would not be dip buying right now. Just stack and accumulate. They could do this for a long time, so just keep that in mind. But I'll keep you updated on this. And thanks for watching.